Hello, I'm David Frazier with Investors Monitor, and this is our daily market insights show where we strive to tell you everything that you need to know, but nothing more, regarding factors and developments that are likely to impact the value of your investment portfolios. So, starting today, we're going to begin airing our show in the mornings every day, every weekday that is, at 9 o'clock Eastern Time, 9 o'clock a.m. Eastern Time, in an effort to better prepare you for any given trading day in the U.S. financial markets. And we're going to rename our show Frazier's Morning Market Prep to better align, the title of that show with what we're actually striving to do. So we're recording today's show at around 8:45 in the morning on Thursday, September 3rd, and we expect to have this show completed and produced and to be ready to air at right around 9 o'clock a.m. Eastern Time this morning. So let's begin by talking about what's going on in the futures markets for the U.S. major stock market indices. And as of around 8:45 a.m. this morning, the Dow futures were up a little over 100 points. So we're probably going to see a positive open today in the U.S. stock market. But I doubt any advances that we might see throughout the trading day today, I doubt those advances will last for long. And the reason I say this is what I've been saying over approximately the past week and a half, and that is contrary to what a lot of these folks that go on these daily broadcast financial shows have been saying regarding the recent big drops in the U.S. stock market. Our research indicates that the declines in the U.S. stock market that began actually on May 21st, the big drops did not begin until August 18th, but we have trended lower since May 21st, believe it or not, when the S&P 500 rose to an all-time high. Since then, well, let me back up a bit. As I was saying, as I'm sure you probably know, most of these financial market pundits that go on the major broadcast TV shows have been telling you and other investors that the big drop that we've seen in U.S. stock prices is due to a slowdown in economic growth in China. And I've been telling you quite the contrary, that that's a bunch of nonsense. And I find it interesting that in the Federal Reserve's Beige Book, they call it the Beige Book. I don't know if it's still done today, but for many years, this was a beige color book that contained notes from the 12 Federal Reserve bank presidents throughout the country on economic developments in the regions of the country. That's why it's referred to as the Beige Book. And in the latest Beige Book report that was issued or made available, I should say, to the public yesterday, there was extremely few comments from any of those Federal Reserve bank presidents regarding economic developments in China. I mean, extremely few comments. And you would think, well, gee, these Federal Reserve banks, they employ a lot of economic analysts, and surely if those analysts were seeing a negative impact on the U.S. economy from developments in China, they would have commented on it. Well, I'm sure there's a good reason why there were extremely few comments by those folks, and that is they likely saw the same things that I have seen. And that is this economic slowdown in China has extremely little to do with the drop in U.S. stock prices. Quite the contrary, our research here at Frazier and Mayer Research, LLC, the providers of Investors Monitor and InvestorsMonitor.com, the research that we do on a regular basis, looking at more than 100 economic statistics from around the globe, clearly indicate that the pace of economic growth in the United States is going to slow over the next few months. Now, it's very, very important to note, as I've noted in the past, that I don't see a recession coming. I think there's very, very little chance of an impending recession. But the indicators do show that we're going to see a slowdown. And we've heard several sell-side analysts and portfolio managers at brokerage firms, that is, folks that want to keep individual investors in the markets fully invested at all times because they make more money if they do that. And I don't want to get into the details of how that works, but that is a fact. We've heard these folks point to the second quarter GDP report, the gross domestic product here in the United States, the total output of U.S. goods and services, and economic growth. And they pointed to the second quarter GDP report and saying that the U.S. economy is still strong and growing at a healthy rate. And as I said a few days ago, I don't really care about the second quarter GDP report. I mean, that's a report for the 3 months ended in June. And so that's more than 2 months ago now. What we focus on here at Frazier and Mayer Research and Investors Monitor are leading economic indicators and leading stock market indicators, because we want to have a very good idea, or the best that we can, of what's likely to happen in the future, not in the past. The level and direction of stock prices is not determined by what has happened in the past. It's determined about what is likely to happen and what people expect to happen in the future. So, a preponderance of data regarding leading economic and stock market indicators suggests we're going to see a slowdown. And secondly, approximately 1,100 earnings reports that I reviewed from publicly traded U.S. companies for the second quarter of this year indicate that we're going to see earnings at U.S. corporations, or at least publicly traded companies, likely grow at a slower rate during the third quarter of this year. And in the aggregate, I think there's a good chance we're going to have a decline in the aggregate of the corporate earnings of U.S. publicly traded companies. I mean, corporate earnings already peaked during September of last year, fell about a little over a percent in the fourth quarter of 2014. Of course, that's very, very modest. But then we're down over 7% in the first quarter of this year, and rose very, very modestly in the second quarter. So if we do, in fact, experience an economic slowdown over the next few months, and corporate earnings, the rate of growth increases or possibly even decline, or very, very potential, I should say, decline during the third quarter, well, people that do a lot of research, like myself and my firm, and like a lot of analysts at the buy-side investment firms, when I say the buy-side, not firms that buy stocks for their investors and do analysis or try to determine what's the best way to position their portfolios, as opposed to sell-side analysts, who are folks at brokerage firms who are always trying to keep people in the markets. And these analysts at these buy-side firms, such as mutual funds, pension funds, insurance companies, they very likely see the same thing that I see. And I'm quite sure that's why institutional investors in the aggregate added to money market securities, added to their holdings of money market securities during each of the past 3 months, and reduced their allocations to growth and cyclical stocks during each of the past 2 months. So, okay, enough about that. Let's get into some important announcements that were released yesterday. And gee, I might have to, well, what have I done with my glasses? I'm not sure, but hopefully I can still read this. So, first of all, let's take a look at factory orders. The U.S. Department of Commerce released yesterday, on Wednesday, September 2nd, that is, figures for factory orders here in the United States. And they reported that factory orders were up slightly during July versus the prior month. And of course, the general financial media spoke about this as if this is a big positive. Well, that's only 1 month. And I always look at, my firm always looks at, month-to-month changes in major economic variables. We also like to look at what happened in any given month versus the same month a year ago, or during any quarter versus the same quarter a year ago. Because, you know, month to month, you can get a lot of volatility. Year over year, you don't tend to get as much volatility. So even though factory orders were up slightly during July versus June, they were down by 14.7%, down almost 15% versus the same month a year ago. Yeah, so that's, I think I've mentioned over the past few days, you know, how we've had a big slowdown in the manufacturing sector of the U.S. economy. That is, an economic activity in the manufacturing sector. And this is just one more statistic that clearly reveals that. The factory orders on a year-over-year basis, that is during July versus a year ago, were down almost 15%. Well, that's not nearly as positive. Quite the contrary, it's quite negative. Let's leave it at that. And then in looking forward, the Institute of Supply Management, which conducts a monthly survey whereby it calls thousands, I think it is. I should get the number, but I'm quite sure it's well over 1,000 manufacturing executives every month, and ask those manufacturing executives in what they're seeing at the companies that employ them. Is manufacturing activity increasing or decreasing in any given month? And even though the comments from those manufacturing executives for the month of July indicated that manufacturing activity likely increased modestly, still the overall trend in manufacturing activity here in the United States has trended lower since September of last year. Since September, so that's that's down for trending lower for 9 months. A big slowdown in the manufacturing sector. Now, let's move on to the housing market. We also got a report, a weekly report from the Mortgage Bankers Association that was issued yesterday that showed that applications for mortgages to buy a home were up 11.3% last week as compared to the prior week. Well, yeah, that's pretty darn positive. In fact, it's very positive. And applications for mortgages have actually trended higher since the beginning of July. So, trended higher during each of the past 2 months. However, even though that sounds really positive, I have found in doing very, very in-depth economic research for more than 25 years that mortgage applications tend to be somewhat of a lagging indicator. So just because mortgage applications turned higher over the past 2 months, I wouldn't get too excited about that in a positive way. And the reason being, if we look at a leading indicator for the housing market, as well as a very reliable leading economic indicator for the overall U.S. economy over at least the past 50 years, and that is building permits issued for the construction of new homes. Well, building permits issued for the construction of new homes fell more than 16% during July as compared to the prior month. So, I focus more on that because it's been a very reliable leading indicator for the overall economy, not just the housing market, for at least 50 years. And so I wouldn't pay too much attention to these mortgage applications, even though it's just one. It's a piece of the puzzle that we here at Frazier Mayer Research analyze every week. Now let's get into another supposedly very positive announcement issued yesterday by the U.S. Department of Labor, and that is a report on productivity. Well, if you listen to the mainstream financial media, you would think that there were some really positive, wonderful gains in productivity here in the United States during the quarter ended June. That's these statistics that came out yesterday refer to the quarter ending in the 3 months ending in June of this year. And the reason being, The major financial media told us that productivity, that is the number of units of goods produced per employee at U.S. businesses, rose at an annualized rate of 3.3% during the second quarter of this year. And that's pretty darn positive. But if you look deeper into that, which we did, what we found is, well, first of all, that annualized rate, so what they do is they take the change in unit output, that is productivity, in the most recent quarter compared to the prior quarter, and then they multiply it times 4 as if it's going to continue at that rate, which is, of course, a bunch of nonsense. That would be the same as measuring the height of my 12-year-old daughter in any given month, and if she grew by an inch, to multiply it by 12. Well, of course I wouldn't do that. That's just nonsense. So we prefer, once again, to look at year-over-year changes. And if we look at year-over-year change in productivity, productivity rose only by 0.7% during the second quarter of this year as compared to the second quarter of last year. Well, it's a lot different than the 3.3% annualized that you heard the mainstream financial media talk about. Productivity rose by only 0.7%. And then something else that we do, we don't look at just output per person, we look at the cost per unit of output. So productivity compared to the cost to produce any a particular good. And what we found was that unit labor cost rose by 1.7% during the second quarter as compared to the second quarter of last year. So the cost of U.S. companies to produce a given good rose substantially more than the number of goods that they were able to produce. And what does that tell us? It tells us that a negative gap has formed between output per hour and cost per hour. A negative gap is formed. That meaning that output per hour is now below cost per hour. And why is that important? Well, it's important because the profits or the net financial operating results of any given company are determined by subtracting their costs, that is their expenses, from the revenues, their sales revenues. And if expenses go up more than revenues, well, your profit margins are going to decline. It's a good chance that your overall net profits are going to decline. And what we have found going back to the year 2000, we could go back much longer than that. I'm sure I have data back beyond that, but I'm looking at a chart here that I printed, and it's just from to 1999 to be exact. And what we have found is that any time that we've seen this gap begin, negative gap, that is where unit labor costs, the cost to produce a given product, go up above output per hour, whenever we've seen that gap where the costs are higher than the productivity, well, guess what has happened? Stock prices have trended lower. Not surprising to us, because I said that means the profit margins are going to get squeezed, and you might see a decline in overall net profits. And that kind of matches well with what I told you a few minutes ago regarding the 1,100 earnings reports, second quarter earnings reports that we recently reviewed and analyzed of U.S. publicly traded companies. So, most of what you hear in the financial media, for some reason, they always just want to focus on the positive, and they always want to talk about, how the markets will go up over the long term. Well, some of us are going to be dead over the long term, right? I mean, do I really care? Let's say I'm 100 years of age, and I have a lot of money in financial markets, and someone tells me that the stock prices trend higher over the longer term. I don't really care, because I might be dead 2 years from then. So I want to also know where they're going to go in the intermediate term as well as in the very short term. So then, let's get into the ADP employment report, automatic data processing. That's ADP, who provides payroll services for thousands of companies around the globe. Well, they reported yesterday, which they do every month, that in the private sector of the U.S. economy, that is non-government, any non-government sector, that jobs rose by 190,000 last month, and that's higher than the month before. And of course, that's a good thing. However, if we look closer at what's been going on with the creation of jobs in the private sector, they peaked during November of last year and have been trending lower ever since then. So that's obviously not a good thing. And we got a big report, a very important employment report out tomorrow. That's the employment report from the U.S. Department of Labor on all types of jobs other than jobs in farm-related sectors of the economy. That will be out on Friday, the non-farm employment report. And along with that is announced the unemployment rate and various other employment statistics. And jobs in non-farm sectors of the economy, that is including government jobs, private sector jobs and government jobs that are non-farm sectors, also peaked during November of last year and have trended lower since then. And then if we look at a leading indicator for the employment market, as well as a very reliable leading indicator for the overall U.S. economy, and a very reliable leading indicator for the direction of stocks, and that is overtime hours worked by manufacturing and production workers. Well, that peaked during December of last year and is fallen fairly sharply over the past few months. And then we'll go on to one more statistic. I know I'm covering a lot here, but I'm trying to give you what, as I said, what we strive to do every day is to provide you with all of the information that you need to know. And these are very important factors that I'm telling you about and nothing more. So we're going to move on to online postings of job advertisements by U.S. employers. And what we saw was that even though total postings rose slightly last month, new postings, that is new job ads that were put up just last month, not a combination of all jobs that might have been put up several months ago that are still posted, but new job ads that were posted during the last month fell sharply during July and have trended lower since May of this year. So, the employment market in the United States appears to be weakening. Now, I was going to get into some, I guess I can do this quickly. As far as international developments, industrial production declined in Japan last month. Retail sales in Japan declined. As you probably already know, manufacturing activity in China declined a bit. And that's, even though the U.S. drives only somewhere between 3.5% and 5% of its total exports from China. So, I don't care a whole lot about what's going on in China. It has little impact on the United States. But Europe has a lot more impact on the United States. The United States exports a substantial portion of its total exports to Europe. And manufacturing activity actually improved in Europe last month. Of course, we didn't hear the media talk about any of this. And then if we just go to the daily trading action in the U.S. stock market, of course, the Dow Jones Industrial Average was up 293 points yesterday, but that's after the Dow was down 470 points on Tuesday, and the trading volume was much lower yesterday. Yesterday on Wednesday, the Dow was up 293 points, but it was down 470 points on Tuesday. And yesterday, that is Wednesday, the trading volume was much less than what it was on its big down day. So once again, that suggests that in the aggregate, that institutions were unwinding their positions. So I've gone over a lot, and what I've talked about here today, as well as over the past couple of weeks. We're likely to see a slowdown in economic growth in the United States over the next few months. We're likely to see corporate earnings deteriorate in the aggregate. And this is why stock prices, in our opinion, have moved to lower in the past, sharply lower in the past few weeks, because institutional investors are likely looking at the same thing that I am, and even though they're telling you everything's fine because they want to keep you in the market, everything's not fine. No, we're not going to go into a severe recession. I don't think we're even going to go into a recession, but we're likely to see stocks prices in general here in the United States continue to trend lower over the next few months. So I thank you for listening and watching, and I remind you once again, our goal is to tell you everything that you need to know, but nothing more regarding factors and developments that are likely to affect the value of your investment and trading your financial portfolio. And we truly are looking out for you. So I encourage you, if you're not watching this show at our internet website, to go to our website at investorsmonitor.com. We post important news every day of the week. We post daily charts of important variables that affect the financial markets in our chart of the day section. We post results of corporate earnings. We have over 100 economic indicators where we have not only the charts of those indicators, but data going back many, many years. And I also encourage you to sign up for our free weekly market commentary. You do not need to give us a credit card. All you need to do is put in your name and email address on the homepage of our internet website. So we thank you for once again for watching and listening, and we hope you tune in again tomorrow morning around 9 o'clock. Thank you.